Hey, thanks for stopping in. I do understand that content like this is supposed to be for entertainment purposes, and at the end of the day, what you do is on you. But I wanted to let you know that I'm never going to put content out on this channel that I don't have a lot of experience with. I've been doing mortgages for a little over 26 years, but even with that experience, I still research the content before I put it out there. I want to make sure that something I learned a year ago or 10 years ago is still relevant and accurate. So with that, thank you again for stopping by the channel. Welcome to WTF Mortgage, and thank you for checking out this video, which is going to be on what is involved in getting the lowest interest rate. And the reason why I'm doing a video like this is to prepare you for the upcoming rate drops, maybe in about 2.5 months or so, 2.5, 3 months. Because if you start trying to get prepared when things start dropping down, my experience is that it's going to be too late and you're not going to get the best deal that you can get. All right, so let's go ahead and get into the video. And I'm going to kick this video off with this. We all have the same interest rates. I'm kind of chuckling because I've mentioned that like 100 times before to people. We all have access to the same interest rates. Every bank, every lender, every brokerage, every credit union across the country, we have the exact same rates. The big difference is what we charge in fees for those different interest rates. Think about it like any other retail store. You've got these different retail companies, say, carrying the same product, but each of the stores has a different price for these products. It's the same way with us. We have the same interest rate products, but they cost difference, and you're out there shopping for the company that has or you should be out there shopping for the company that has the cheapest fees for that particular product, or in this case, that particular rate. Check out this chart really quick I'll put up on the screen here. Notice this is just a spread of some of the available interest rates going from this 5.99 to the 7.5. Look on the left, check out the rates, then look to the far right, and you'll see the cost for those rates. Notice how the lower the rate, the more expensive it is. As you go up, then you get to the middle, and then the higher the rate, the less expensive it gets until you actually start getting credits. And that's how it is at every single company, and you are shopping for the interest rate with the lowest amount of fees, the rate that's going to be right for your scenario. So the lower you get those fees, in other words, the lower you can get the interest rate. I'll say that one more time. The lower you can get those fees, the lower you can get the interest rate. This is important to wrap your head around because I'm about to show you the 5 primary factors that influence the cost of these interest rates. All right, so let's get into that. And if you would please refer to the visual aid that I just threw up on the screen here, you're going to see the 5 factors that influence your interest rate pricing. Kicking it off with the loan level pricing adjustments, or we'll just call them pricing adjustments for short. Going into the type of company you are dealing with next, and then the loan type, and then the loan originator you are working with. A loan originator is the official nomenclature for what most people call loan officers. Some people even mistakenly call them brokers, but these are the mortgage loan originators, or as you might be familiar with them, loan officers, which is not an official title. That's something that was made up a while back and it kind of stuck. And then finally, what you negotiate with that particular company, which even though it's the last one, it's the one that you probably have the most control over and the one that could have the most influence. So let's go ahead and kick it off with the pricing adjustments. And as you can see, pricing adjustments kicks it off with probably one of the most familiar ones and likely one of the most important ones: your credit profile. All right, so I want to say this: credit is a video in itself. There's so much involved in it, but I do want to say this: if you're doing, say, a purchase or any type of, a refinance in a couple years, you're planning to do something in 2 or 3 years, whatever it is, a purchase or a refinance, and you have issues on your credit, start taking care of them right now. It is my experience, as someone who has looked at thousands of these credit reports, literally thousands over the years, that it takes quite often longer than you think to take care of some derogatory items on the credit. So you want to purchase something in 2 or 3 years, please start working on the credit issue right now. All right. Because here's why it's so important here. One of the things, check this scenario out. This is a real scenario. I priced this one out yesterday. Same scenario with a 6.5% rate, 740 credit score, no fees. Same scenario, but with a 670 score. That's the only difference. $9,077 in fees. So $9,000 in fees more just with that difference in the credit score. That's how important it can be. So please work on the credit. If you've got some issues, work on it ahead of time while you have time. All right. Next thing would be the amount of equity you have in the property. Say if you're doing a refinance, you have no control over that. It is what it is, unless you have some money on the side and you want to pay your loan down. But usually you can't do anything about it. Same thing with the down payment. How much you have for a down payment, it is what it is. But just to let you know, this other little tip in regards to purchases, down payments, if you are putting 20% down and you have the capacity to put another additional 5% down, ask the mortgage loan originator you're working with, hey, if I put 25% down instead of 20% down, what would it be? Your chances are you might get a significant price reduction on there. So ask, all right? Same thing goes in the opposite direction. I know this is going to sound weird. If you are putting 25% down, ask the loan originator, hey, what would it be if I put 5% less down? If I put 20% down instead of 25% down? Ask them about that. You might get lower pricing. Why? It's because it's not just the amount of equity in the property. It is the size of the loan. Now, I didn't put that as a pricing adjustment, but the size of your loan impacts the pricing behind the scenes. It certainly does. So let's say you put 20% down instead of 25%. That's going to make the loan amount a little bit bigger. And that little bit bigger loan amount might cross that sweet spot threshold and you get a discount on it. Long story short, always ask. Don't leave money on the table. And that same thing would apply to, say if you're putting 5% down, but you can put 10% down, ask the loan originator, what would it be if I put 10% down? All right. So that's what the equity in the down payment, property type, something you really can't control. It is what it is. I mean, it's going to be a difference in pricing from a manufactured home to a single family residence, a big difference in pricing. But if you're in love with that area, you're in love with that manufactured home, it is what it is. So you don't have that. I just want to let you know there are pricing bumps for this. Same thing with a condominium to single family residence. Some types of loans, some places, there's a small bump, not a big one, but a small bump in the pricing. Just letting you know. All right. So property type, one you really have, not much control over. Occupancy. Just bringing it to your attention because this is another one where it is what it is. If you're buying an investment property, it is what it is. Investment property pricing is going to be more expensive than primary residence. Something that a lot of people don't know, even though, this is, pretty common. So yes, there's going to be a bump in the pricing. Just be prepared for that. It is what it is. You're also going to have to put more money down on the investment property. And you can also get a bump for a second home. Not all places give you a bump and not all types of loans, but some places you'll get a bump in pricing, a negative bump in pricing for a second home. Just letting you know, occupancy does impact it. And then finally on this list, whether you have taxes and insurance included or not, depending on the type of loan you're doing and the company that you're working with, if you have the option to not include your taxes and your insurance and you elect not to include them, that could be a pricing bump depending on the type of loan and the company you are working with. A lot of companies like mine, if I can pay that for them, and if they don't want it included, I'll do that. But if I can't, I can't. It's something that has a pricing bump, that negative pricing bump that has to be passed on. Now, these are not all of the pricing adjustments. There are many, many more. These are just the pricing adjustments that you are more likely to encounter. In fact, you're definitely going to encounter these. All right. So that's it for pricing adjustments. Let's go ahead and bump on over to the next factor, which is the company. All right, we're at the company. Now, this is the type of company you are dealing with, not the company you're dealing with. And what I mean by the type of the company, whether it's a bank, whether it's a brokerage, whether it's a lender, or it's a credit union. Now, this is a topic for a lot longer video on its own, so I just want to touch on a couple bullet points. What I will do is put a link in the description so you can, I'll put a link to a home loan shopping course I did. The course is comprised of like 19 videos. So I'll put a link to one of the videos where I cover this in depth. So right here, I just want to touch on a couple things for your benefit in this video, all right? Because I'm trying to keep it quick here. Banks, brokerages, lenders, credit unions. If you are doing a true jumbo loan, and the jumbo loan is going to be determined by the county that you are living in, I will put a link in the description of this video. If you're not sure what the jumbo cutoff is in your area, I'll put a link. You can look it up by county. But if you're doing a true jumbo loan, the banks 99.9% of the time are going to be the way to go. The big banks, they're going to have the best pricing on those jumbo loans. But you need to be well qualified. I'm talking about your credit score is higher than 740. You're putting a minimum of 20% down. Better if you're putting down more. Stable, verifiable income. Everything about you is absolute cherry. All right. Because if you're not well qualified, you ain't going to get this. So a well qualified true jumbo loan, that's the realm of the banks. It's been like that for years and years. And you're hearing this talking from a broker, all right, who has a brokerage. So you know the truth. It's not like I'm working at the bank. I did work in the banks over the 26 years I've been doing this. I've worked equal time at banks, brokerages, and lenders. And so this is inside information I am giving you. Yes, they have the most aggressive true jumbo pricing. All right. They're not that aggressive when it comes to regular pricing, but jumbo pricing, that's where they excel. Also, home equity lines of credit. Banks are typically the place to go for home equity lines of credit. Again, if you are well qualified. If you ain't well qualified, it ain't going to work out so great at the bank. All right. Next, brokerages. Ooh, this is like one of the, I almost call it like the best kept secret. And funny that I say that because brokerages account for a massive amount of loans in the United States. A lot of people don't know what even the brokerages are. So brokerages are either managed by a broker or owned and managed by a broker. A lot of people think a broker is a generic name for a mortgage loan originator. It is not. It's for the individual who is licensed to run the company level organization, either manage it or own and manage it. So, and at the brokerages, depending on the flavor of the broker, you will get some phenomenal pricing, with the exception of in a couple different areas, but most of the time you're going to get some phenomenal pricing. This is why if you check out this article here, I'll put a link to this article in the description of the video, but show you a quick blurb. This is out of a Yahoo Finance, where it shows that on average, people saved, after this study that was done, people saved over $10,000 by working with a broker. Pretty freaking crazy, huh? So I'll put a link in the description if you want to read to that article that was on Yahoo Finance. So how do you find a broker, even though so many people don't know about them, where you can get these outstanding deals? The best way to find a broker is go on the internet and just type in, I'll do a local search. Like say you live in San Diego, but mortgage broker San Diego or mortgage broker San Francisco or whatever city you live in. Don't do it by state, do it by the city. So you get those local brokers will show up there. All right. The other thing I'm going to throw out there, if you need to do a jumbo loan and you are not well qualified, the broker is going to be the way to go. Most lenders will blow off the true jumbos loans because they make an absolute shit ton of money doing the conforming loans and govy loans, and most of the lenders don't pay much attention to the jumbo category. And this is in general, again, somebody who's worked at the lenders giving you the inside information. So also, if you're not well qualified but you need a jumbo loan, the brokerages are going to be the way to go. Brokers even can do HELOCs. Not all of them do them, but they can even do HELOCs. So you can't get a brokerage. You can't get a HELOC at a bank. You can't get it at the credit union. You want to go to the brokerage, although there are some lenders also that will do HELOCs. Not many of them, but there's some that will do HELOCs. They have about the same pricing as the brokerages do. Okay. And that's for if you're not well qualified. So that brings me into lenders. Speaking of lenders, and the big thing I want to pull off, what I want to say with lenders is this, and I know if any large lenders happen to run across it, they might tell me to kiss their ass, but I'm going to put it out there because this is the truth. Size matters with the lenders in the opposite direction. Time and time again, I've seen the smaller lenders have way better pricing, way more aggressive interest rate pricing than the big lenders. And that's due in large part from my observations and from working on the inside of the lenders is this. I've worked for two major lenders whose name I won't mention. You know them all for a long time. What it is this. Once they start to grow, they start to incur some crazy expenses because they're the ones advertising on stadium, slapping their names on sports stadiums, putting their names on NASCARs and these big commercials and paying for all this web positioning in there. That's expensive, and somebody's going to pay for the expense, and it's not them. It's going to be in the form of their interest rates for the customers that go to the customers. And essentially, customers are going to be paying for that in the form of the interest rate pricing. Also, once they get branding, this is something they purposely do. They can charge higher interest rate cost because they're branded like that, and a lot of people gravitate towards the branding. That's why they're doing that. That's why they're spending millions on these commercials and these sport NASCARs and stuff like that, because so they can get branding and they can charge more. And the smaller lenders that are don't have that branding and are still aggressive in their pricing, that's where you can get some really kick-ass deals from lenders. How do you find them? Same way that you find those hidden brokerages. You go and do a local web search. Mortgage Lenders San Diego, Mortgage Lenders San Francisco, or wherever you live at, and you'll pull up those small lenders that you don't see advertising out there. All right. So finally, that leaves me with the credit unions. Now, I never worked at a credit union, but I've worked with tons and tons of customers, hundreds that are members of credit unions. And I'll say this is my opinion. Credit unions can be hit and miss. A lot of times miss, but when they hit, they knock that shit out the park. That's why I always say, check out your credit union. They'll do some crazy things sometimes for their members that other places will not do. They are also a great source for home equity lines of credit. A lot of credit unions actually kick butt on the bank pricing for home equity lines of credit. All right. So that's it with the types of companies. Let's go ahead and move on to the loan types. All right, and here we are at loan type. I'll touch on this quickly because you have limited control over this. It kind of is what it is. But just to let you know, there is a difference in pricing between conventional, FHA, and VA loans. So with conventional, if you are well qualified or average qualified, average to well qualified, and you do not have VA benefits, you're going to be rolling with a conventional loan. That's pretty much cut and dry. Again, you're average to well qualified. You don't have VA benefits. You're going to be rolling with conventional. It is what it is. If you are not average qualified, you're below average qualified, and you're looking to do that purchase or refinance, and you do not have VA benefits, that's where FHA is going to come into play. FHA used to be a benefit for less than perfect credit and those who didn't have enough money for a down payment on a conventional loan. But now conventional loan is absolutely kicking ass for down payments. The conventional loan goes down now as low as 3% for down payments, and there are down payment assistance options that you can piggyback on top of that and put no money down. So conventional is kicking ass in that category, but you got to be well qualified. If not, you're going to roll with FHA, FHA 3.5% down, etc. The only hitch in the giddy up with FHA is this mortgage insurance premium that you have on it. And it's like PMI on the conventional loans. PMI, private mortgage insurance. But FHA calls it mortgage insurance premium, MIP. And there's what you pay monthly, and there's an upfront mortgage insurance premium. That's fairly significant. The good thing about the upfront premium that you pay on both purchases and refinances is that it gets added into the loan. You don't actually pay it out of pocket. But if you can get into that house where you otherwise could not, and you got an outstanding deal on it, boom, you can move on that. There are people I did FHA loans for in 2017, 2018, 2019, at the beginning of 2019 that are damn happy now because they didn't sit around and wait. And now they're sitting on this home with a ton of equity, and they've already refinanced out of their, two of them already refinanced out of their FHA loan. The other one, the rate was so low, they just decided to keep it, which brings me to the next thing on FHA. FHA, you will get a lower rate most of the time than you will in conventional. But the thing about it is you've got that mortgage insurance premium tacked on there, which it could be significant. That's like having a higher interest rate. So it's kind of a trade-off. You get a lower rate, but the mortgage insurance premium tacks it up. Now, the big difference about the mortgage insurance premium on FHA and PMI on the conventional loans is that the mortgage insurance premium is going to stay there for the life of the loan. That's the only problem. You're not going to just be able to get rid of it when you have enough equity. It's going to stay on there. So that's the problem with that, or could be the problem with that. Again, if you get a low enough interest rate, won't be, you might just decide to keep your FHA loan instead of refinancing. But again, FHA would be doing it for credit purposes. VA. Now, I did a whole separate VA breakout. It's in the description of this loan. I did a video just for this video. I did a supporting video. It's a VA breakout because I don't want to take too long in this video. I'm just going to say this. Veterans, please check out that breakout video in the description of this video, because I want to tell you, don't let anybody who doesn't know what the hell they're talking about, which is a lot of people out there, about mortgages, give you bad advice on the VA loans. I don't care who it is telling you, oh, no, you don't want to do a VA loan, it's too expensive. They don't know what the shit they're talking about 99.99% of the time. Hell, I'm just going to call it 100%. So look into it. Make sure if you are a veteran or a eligible party, check out both. In your well qualified, check out both conventional and VA. Don't leave that on the table. I'm not going to beat a dead horse because I made a whole separate video of that. But there's so many people out there who don't know about mortgages, who love giving out mortgage advice. I have no damn reason why. And on top of that, they give out shitty VA loan advice. So please check out the breakout video that I have in the description of this video. Don't leave that on the table, veterans and eligible parties. Check out your VA loan benefits that you earned, okay? All right, so let's go ahead and go into the next factor here, the loan originator. Let's talk about the mortgage loan originator. This is going to be your ace in the hole, and a lot of people don't know this. A lot of people don't know how much of an impact the mortgage loan originator has on you getting a basic deal or a kick-ass deal on the interest rate. The mortgage loan originator, that is the one, the person who initially negotiates the terms of the loan with you, that advises you, that takes your application, the one who you are in contact with the most initially. This is the mortgage loan originator. These are the ones that people typically refer to over the years as loan officer or mortgage banker. Some people mistakenly call them broker. These are the official nomenclature is mortgage loan originator. So when you hear me refer to them as that, so this mortgage loan originator is the key player in you getting a discount. A lot of people just write them off as, oh, they're just some stupid salesperson taking the application. No, they are not. If you're not getting a kick-ass deal on the interest rate, I'm telling you, 99.9% of the time, it's because of them. So here's the thing. Here's why it's so important to get someone with experience in the industry and experience at that company. I'm talking about the mortgage loan originator, because if they're new, a couple things happen. If they're new, they're just trying to stay on top of the job as it is, trying to go through the process of getting a discount for their customer. On top of that is something that most of them are ill-equipped to do. Now, there are a lot of companies, what they'll do, not a lot of them, but a significant number of the large companies talking about, in particular, by the way, what I'm going to say now applies mostly to those larger places, larger lenders, and those big banks. So the mortgage loan originators, when they're new, they're not necessarily equipped to go through that process, because there's a certain process that they have to go through. They can't just give a discount. It's not like they're selling some used cars or something like that, and they can discount on the price, to make the deal happen. The government regulates how we discount these loans. We can't they want us giving equal treatment to everyone. So we can't just, say you have a discount and you have a discount. Everybody gets a discount. It doesn't work like that. everything is regulated and has to be documented, when and why we gave the discount and how much of a discount. The bigger the discount, the more documentation we have to provide, of course. And so this process for the new people, someone new, it's not something that most of them are equipped to do. Also, there's a little bit of a process. Sometimes I call it like a hazing process. When a new person trying to on the phone, trying to get a discount, a lot of times at those big, larger companies, I worked and saw it firsthand what happens. The manager might tell them, you know what, shut up and go down and sell that loan properly, instead of asking for a discount. Essentially, they're saying, you know what, piss boy, piss girl, shut up, don't ask for discounts until you get some experience, just go do your job and get it. And then there are other companies that are different. But, so there's some challenges, long story short, for the new loan originators, trying to get a discount for their customers. So a lot of them will not even bring it up. But the other thing is, if not only that, they're new to the company. In fact, you could have an experienced mortgage loan originator who is new to the company, and that's going to be a little bit of a handicap also, because they don't know the ins and outs of how the process works at that company, and who and what wheel to grease and who to talk to. And yeah, it is like that sometimes, and a lot of times in some cases, it's about who to talk to and who to make it, who you need to go to make it happen. Again, if you've got some experience at the company, experience at the industry, you're better equipped to get your customers that discount. It's following the process, not just the process to be compliant with the government, but also following that company's process. All right. Then the next thing you have is the bad side. If it's really, you want to count it, bad side of the mortgage loan originator compensation rule that was enacted in 2013. I love this legislation. It's one of the good things that happened to the industry, because I was in the industry when there was no regulation on this. When we got paid, my second company I worked at, we got paid based on a percentage of the fees. Fucking crazy. Just opened the door for all kinds of stupid jackassery to occur. These greedy asses, it just was a bad thing. So the Mortgage Loan Originator Compensation Rule, you can look at it on the CFPB, the Consumer Financial Protection Bureau's website. If you want to read about it, if you're bored, if you're on the toilet, whatever, you need to kill some time, just look up Mortgage Loan Originator Compensation Rule, or CFPB, acronym for Consumer Financial Protection Bureau, Mortgage Loan Originator Compensation Rule, and you could read about that. This law prohibits us from being paid on things like the interest rate, what interest rate you choose, or what you pay in fees. You can pay $1 in fee or $1 million in fees. We get paid exactly the same, even me as the owner. And then same thing with the interest rate. 0% interest rate or 20% interest rate, our asses get paid the same. So there's the good side about that is you can't be steered into a loan. A lot of people don't even know about this rule, so they still have this fear in their head that the person is trying to charge them a higher interest rate or something like that, or more points or points to make more money. They make the same damn amount every time. Customers are safe. They can just choose the rate that's right for them without worrying about somebody steering them into something to make more profit. There's a little bit of a dark side to that, a shadowy side to that, and that is, since they're not making money off that, off the rate or the fees, some of them don't give a shit, and that's a shame. I hate even saying that, but some of them don't give a shit. So whether you get a discount or not, they don't give a horse's ass, half a horse's ass, whether you get a discount or not, as long as they get the business in and get, whatever bonus they're going to get. Doesn't matter what rate you choose. So they don't put the effort in. I saw that happen during the really, really busy times, where they don't even want to spend the time doing that. They're like, just put it in, so they don't fight for their customers or try to do that. Unfortunately, that's a reality of it. So you got to find somebody, A, who has the experience in the industry, B, who's been at the company long enough to be able to talk to the right people, push the right buttons, and that is motivated to help their customer. I recommend looking up the person you spoke to afterwards, and you can look up their experience. Just go on the Nationwide Mortgage Licensing System, Consumer Access. You go on you access that, just type in NMLS. That's the acronym for Nationwide Mortgage Licensing System, or Nationwide Multi-State Licensing System. It goes by both names. You go on there, you can punch in their ID number. Their ID number is on every email they send, their business cards, everything that they have. That ID number is supposed to be on there, and they're supposed to tell you that ID number over the phone if you're talking to them on the phone. If they send you any correspondence in the mail, their ID number has to be on there. It's the law. Plug that ID number in the Nationwide Mortgage Licensing System. You can look it up. You can see all their experience, how long they've been at the company, the whole enchilada on there. Okay. And that way you can tell what the background is of the mortgage loan originator you are talking to. So the point of this is, don't blow them off as just the sales jockey taking your application. Whether they tell you or not, that mortgage loan originator is instrumental in you getting a kick-ass discount on the interest rate. Also, one more thing I forgot to mention. With that experience, they have to know. You got to know when to fight your battles. You can't get a discount. The other thing that makes it, in addition to following the federal compliance and following those companies' rules, you have to also know when to push and when to poke and when to prod, because you can't get the same type of discount on every loan. You can't get the same discount on a $150,000 loan that you can get on a $450,000 loan. You're not going to get the same discount on a VA loan that you can on a conventional loan, that you can on the FHA loan. So the persons, and also there's the entire scenario of what's going on, if that's even available. So you got to have the experience to look at the scenario and know when to push and how much to push and what to push. All right. So long story short, find that experienced mortgage loan originator with the, who is willing to work for their customers. All right. So this concludes the mortgage loan originator portion of this. And we'll go ahead and move on to the final factor. All right. What you negotiate with the company you're working with is a topic for an entire video on its own. So I'm not going to cover it here, but I am putting a link in the description of this video to Chapter 4 of the home loan shopping course that I did. So in Chapter 4 and 5, I discussed negotiating with the company. I can't do it in this video because the video will be too long, but check out the description of this video. It starts off into Chapter 4 in the home loan shopping course. I put together how and when to negotiate with the different lenders you're working with. Just know this: most of the places you're working with, you can negotiate, especially if they're a big box lender. Big box lenders have pretty fat margins built into their pricing. Always work with them to get a discount, but there's a certain way you have to do it. So check it out in the description of this video. Big banks, some big banks that they can negotiate too. Some will negotiate more than others, but just to let you know, the opportunity is there. Also, the size of the loan will impact how much of a discount, if any, you can get. When you're working with the true jumbo loans, discounts are far and few between. Also, smaller loan amounts. It's difficult to get anything significant on the smaller loan amounts. You can get a larger discount on a $450,000 loan than you can on a $150,000 loan. It is what it is. Also, you'll be able to get, in more cases, bigger discounts on a government loan like FHA or VA than you can on a conventional loan. And it also varies, like I said, the company you're working with, like my company, my brokerage, I have the pricing already cut down aggressively. I don't cut it down anymore because it's already there. I don't have to worry about being lower. I'm already lower than 99.999% of the places out there. And there are other places that do it like that, have aggressive pricing from the get-go. All right. So that's kind of, I wanted to just go in the description of this video, check out negotiation. I mostly want to let you know negotiation is something. The cool thing about it is you have a lot of control over that. This is the one topic where you have a ton of control over. You just need to do it right, and you can negotiate your way into a lower interest rate. All right. So this concludes this block of instruction, these 5 factors on what goes into getting the lowest interest rate. Drop any questions in the comments, please, so everyone else can learn from it. And I'll see you on the next video. Take it easy.